Good afternoon, and dzień dobry. I'm not able to speak much Polish, but I moved to Warsaw in March this year because my wife is Polish, and she said, you fly around the world all the time, can we live near my parents? And so we're living in Saska Kępa. And there's a lot to say about Poland, which Daniel was asking about earlier on, in that it's risen from the 25th largest economy of Europe in 1990 to the 6th largest economy today, and is a very fast-growing and dynamic country, which I love. So enough creeping, except to say, że proszę cię na mobil Polsku. But having said that, Daniel said I've written quite a lot of books, and I'm quite pleased my latest one is actually in Polish. So it has been translated. This is Digital Human. And the book talks about putting a context around where we are right now. Because a lot of people think digital is just doing what we've always done, faster and cheaper with technology. And in fact, if you look at a lot of the fintech community, what they're actually doing is focusing on some of the traditional bank services and products and making them far easier to access and use with technology. Whereas digital is not doing what we've always done, faster and cheaper with technology. It's actually rethinking everything to do with trade, finance, and business, and life, and how we relate to each other. In fact, it's such a revolution that we're going through that it makes the Industrial Revolution look pretty slow. We're going through what is the equivalent of the Industrial Revolution on steroids, because this revolution is so massive in how we do everything, particularly how we do financial services. And when I look at what a lot of the banks are doing, they think they've done digital by rolling out an app or by implementing some open APIs. And that's important, true, but that's not doing digital. Doing digital is a cultural transformation of the company from its core foundations and rebuilding the company, because most banks were built for the Industrial Revolution. That's their business model of finance. It's distributing paper through a localized network of buildings and humans. And digital is distributing data through a global network of software and servers. And you can see the impact that's having across all businesses. And if you look at the industrial era companies, they manufactured and processed and distributed everything. So if you take the old car companies, BMW, 115,000 employees, it's over 100 years old, and yet it's generating less market value than Uber, that has 7,000 employees and is just 8 years old. And when you look at the Ubers and Lyfts and Grabs and Airbnbs of this world, the Amazons, the Googles, they don't actually make anything. They produce nothing. They just connect everything. And that is really what the model of the digital era has to focus upon, connecting people who have things with people who need those things. I need to get from A to B, so give me a driver. I need to find a bed to sleep in, so give me a room. And that's the revolution that I think is far more important in context. In financial services and fintech, I think one of the best examples I've seen of the difference between the industrial era companies and the digital era companies is the difference between Stripe and JP Morgan Chase. Stripe created by a teenager, John Collison, when he was 19 years old with his brother Patrick, who was 21 years old. It's an 8-year-old company, well, it's actually 7 years since the company was founded. And in 2016, it had a $9.2 billion valuation. And I looked at those numbers, and at that time they had 400 employees. So each employee was generating about $22 million in value. Compared to JP Morgan Chase, that started life in 1799, so it's a 219-year-old company. It has 235,000 employees worldwide in 2016. And it generated $245 billion of market capitalization. So JP Morgan's average employee was generating $1 million in value. Stripe's, at that time, 5-year-old company was generating $22 million, 22 times more value. And that shows the chasm between a company that just threw out 7 lines of code as an API, Stripe, compared to a company that has buildings and people all over the world, thousands of them. What's interesting is when you look at the numbers 2 years later, October 2018, last month, Stripe got a new valuation. They're now valued at over $20 billion. And now they have 1,000 employees. So now they're still generating high value, but about $20 million per employee, average. But what was intriguing is JP Morgan Chase. Because in the last 2 years, JP Morgan Chase has gone from 235,000 employees to 165,000. But the market valuation has gone from $245 billion to $365 billion. So in 2 years, JP Morgan Chase has increased in value by 50% and decreased its employee numbers by 1/3. And that's because they're automating and digitalizing the business. They're one of the few that is really taking digital to heart. And that's because they have a great leader, Jamie Dimon. And you may say, not sure about him, Chris, but he understands technology, and he understood the impact that technology was having on JP Morgan's business long before many others, a bit like BBVA, who we all talk about, or ING, or DBS, or there's a number of banks that really get this. And what's happening is that the banks are starting to reimagine their structures and their business models and their products and their services, collaborating and co-creating with fintech startup companies. And I kind of see it as a collaborative environment, almost like a relationship between a parent and a child. Fin is the parent. It wants security, stability, resilience, reliability, safety. And the child is the tech that wants to go around and kick everything and break everything and challenge everything and make you think differently, or try to make you think differently. It doesn't understand why the parents do the things the way that we do. But the parents been there and seen it all before, and there's a reason why we have regulations, guys, There's a reason why we have to have capital reserves. And that symbiotic relationship is interesting between the parent and the child, because nearly all of the fintech startups that I talk to have founders who are typically under the age of 30. They're young people. When you think about the blockchain discussions we were having earlier, what's the major blockchain distributed ledger technology that all the businesses are excited about? Ethereum, written by Vitalik Buterin when he was 19 years old. Teenagers are reinventing banking because they can code. And that's a critical change. And they don't respect the banking system because they don't understand it and don't know why we do things the way we do. And gradually these things are coming together. I was at a conference quite recently where the head of digital for Nordea Group, which is one of the large Nordic banks, introduced their fintech partner. And the introduction was by Ewan McLeod, who's the chief digital officer, who's wearing a suit and a tie. And he's got grey hair and wrinkles like me. He said, "I'm delighted to invite Carl Nicolai, the CEO of Spiff, our fintech partner, to join me on stage." And Carl Nicolai jumped on the stage in his t-shirt and jeans and said, "My 3-year-old son likes to play with dinosaurs. So do we." Kind of not very respectful of the partner they've found. But it's quite clear that we're thinking differently with technology, and kids are thinking differently with technology. And banks are struggling to change to embrace that. When you walk into most bank boardrooms, it is a bunch of dinosaurs. It's a bunch of old men who make all the decisions about where the bank's going to go in the future. The problem with banks is they're run by bankers. They need to have technologists and diversity in the leadership team. And they need to think differently, because how could they understand the import of distributed ledger technology to their business if they don't even understand what a blockchain is? 94% of the people in the boardrooms of banks have never had a role in technology in their life. 4 out of 5 of the big banks of the world have no one who's got experience of technology on the leadership team. This is the issue. When we're going through a revolution that's wiping out industrial era businesses, and we've seen that happen across all other lines of business, if we don't have digital leadership in the executive team of the banks, the traditional large institutions, then they will sleepwalk into oblivion. They won't survive. And so this gets interesting, because the dynamics get interesting. Kids that can code are changing the future of banking and the world. But equally, there are some things that are quite interesting about when I look at Europe and America, because I travel all the time. I travel non-stop. As Daniel said, I just came in from Cape Town with Finovate Africa yesterday and the day before. And for most of the last month, I've been traveling around Asia. And what's interesting is in Europe and America, we really are doing what we've always done, faster and cheaper with technology, which is what fintech is. And in Europe and America, nearly all the things that we have as infrastructure were implemented before Mark Zuckerberg was born. Not here in Poland, because most of the infrastructure here was implemented from the mid-90s onwards. So this is why Poland is a dynamic country, an innovative country. The same is true with Turkey. The same is true of some other nations. But France, Germany, the UK, it's old, creaking infrastructure. It's legacy. When you go to Asia, they didn't have anything in the 1990s either. And in Digital Human, I wrote a case study about Ant Financial, which is the spin-off of Alibaba in China that runs Alipay. And Alipay runs 54% of all mobile payments in China. 38% is on WeChat Pay, which is part of Tencent. And last year, between these two mobile wallets and their other compatriots in China, China spent $15 trillion using mobile apps. In 2014, they spent $1 trillion. So it's increased 15 times in 3 years. This year, it looks likely to be more like $30 to $35 trillion. By 2020, $50 trillion. If you go around China, they don't have cash anymore. They don't have cards. If you present cash to people in China or cards to people in China in shops, they look at you like you're from some weird planet Zog. What are you doing? They've leapfrogged the world in finance. And they don't talk about fintech. They talk about tech fin. They put the tech first, not the fin first. Because fin implies that we're doing what we've always done faster and cheaper with technology. We're automating the fin, which has always been there, the products and services of the banks, lending, credit. If you put the tech first, you can think about this completely differently. And that's what Alibaba and Alipay and Ant Financial are doing. The average Alibaba employee generates $16 million in revenue every year. The average bank employee, Barclays Bank being my example, generates $400,000. That's the chasm between tech and fin. 16 million, 400,000. And when I talk to Ant Financial, what's been fascinating is their story, in that they began life in 2003 running an escrow service, kind of similar to Klarna, if you know Klarna, the Swedish escrow service that's for online checkout. In 2017, when I visited them, they are just embarking on their 5th generation systems architecture. And that's an important statement in itself, because what that says is that every 3 or 4 years, they throw away all of their technology and start again. When's the last time your bank or your company threw away all their technology and started again? Probably never. Or maybe, in some cases, if you're lucky, the millennium bug in the year 2000 got them to do something. The reason why they're generating their 5th generation's architecture is they have an ambition to be supporting 2 billion users, making an average of 1 million transactions per second of payments. And these payments are tiny, and every payment has artificial intelligence for fraud and risk built into the transaction processing. But 1 million transactions a second. If you want to put that in a context, Visa, the global Visa card network, processes an average 2,000 transactions a second. So 1 million transactions a second is amazing. Today, they're processing an average 125,000 transactions a second. So they've already got that scale with artificial intelligence for risk and fraud built into every transaction. But more than that, they have this thing called Singles Day. And Singles Day was on November the 11th. Last year, Singles Day, Alipay processed $24.1 billion in one day. This year, they processed $30.8 billion in one day. Last year, they processed the first $1 billion in the first 5 minutes. This year, they processed $1 billion in 1 minute, 48 seconds. They processed $10 billion in just over 5 minutes. This scale of imagination and capability is unprecedented. There's no other tech company that does this at this scale, except for Tencent with WeChat Pay. And that's why they call it tech fin. They do things like give merchants loans for 5 minutes of $2. Some of their merchants take out 25 loans a day because they can. You know, why do we have annual insurance policies? We have annual insurance policies because the industrial era model of distributing paper through a local network of buildings and humans made it expensive to service and sell. So we only sold them on an annual basis because that made sense in the industrial era. Why can't I have an insurance for the next 10 minutes? Oh, I can. There's a company called Trov that came out of Australia that I can take insurance for as little time as I want on one item that I'm taking out of the house, my iPhone. Maybe I'm going to take my camera or my Mac with me. I can take out an insurance on those 3 items for the next 8 hours for a very small amount. This is where we start to think differently, moving from the technology capability to what can it do. And I guess in conclusion around TechFin and Alipay, the reason why I focused upon them as a case study is that they are a global platform of apps, APIs, and analytics that's spreading around the world very quickly. They are actually the power behind GCash in the Philippines, Mint in Indonesia, Kakao in South Korea, Ascent Money in Thailand, EasyPaisa in Pakistan, Paytm in India. Their apps, APIs, and analytics and experiences and capabilities and technologies are powering payments around the world for financial inclusion. That's the reason why they're getting 2 billion users in their 5th generation systems architecture, because China has 1.4 billion people. They're not Chinese, they're going everywhere. Paytm is one of the most interesting examples because Paytm in India had 130 million users when they brought in demonetization in India. They now have 350 million users 2 years later. Their ambition is to have 500 million banked Indian citizens by 2020. But when I say banked, it's digitally banked. It's not banking as we know it. The guy who founded Paytm was a huge admirer of Jack Ma, Vijay Shankar Sharma. And he went to visit Jack Ma in 2011 and said, I want to bring Alibaba to India. And Alibaba is the biggest investor in Paytm. Paytm and Vijay Shankar Sharma has been a huge success. Vijay is now worth about $10 billion based on the latest company valuation. But 10 years ago, he was homeless. He's 39 years old. 10 years ago, he was bankrupted. He was sofa surfing. He had to choose between whether to have lunch and walk to the job interview or take the bus and have no lunch. It's literally as clear as that in terms of he was broke and today he's the youngest billionaire in India. And that to me is what digital and technology and this revolution we're going through really offers, which is an inclusion for everybody to become an entrepreneur. The digital revolution gives everybody the ability to trade and transact and become an entrepreneur, a creator, a coder, a revolutionary, and change banking, because kids can change banking, because kids can code. And code is changing everything. At the end of the day, banks are not going to go out of business. There's a reason why we have banks, and the reason why they're regulated, because they're stores of value that we can trust. But the banks that are not leading themselves into partnership with kids who can code, to co-create and partner and to collaborate and cooperate and reimagine technology for finance, will just sleepwalk their businesses into oblivion. They will get merged or acquired. In fact, I'm waiting for the day that Revolut or Monzo buys one of the big banks. Maybe it will happen one day. We'll wait and see.